Pacific Asset Management chief economist and market strategist Peter Schiff, and NatAlliance Securities chief of global fixed income Andy Brenner. Andy, let me start with you. You are always somebody who lives and breathes every single word, and you're able to interpret that speak. Interpret it to our viewers right now. What should they care most about that he said?
Powell remained very stubborn. He refuses to acknowledge the fact that the latest beige book, his own research, continues to show weakness in the employment area. Even today, we have Microsoft laying off thousands. It's going to continue. The labor market is much weaker, and he's going to end up eating his words and have to cut much more aggressively than people believe.
Something tells me Peter is chomping at the bit. Peter, you think that the Fed should not cut and that the Fed should hike and that we're already in a recession. So make your case.
Well, first of all, I think the biggest takeaway is that Powell basically admitted that they have no idea what's going to happen. They don't really know what's going to happen to consumer prices. They don't know what's going to happen to employment. I don't even think their forecasts are educated guesses so much as wishful thinking.
To you?
Well, no, but I don't claim to know. But I do believe that inflation is going to be a lot higher than the Fed believes, and the economy is going to be a lot weaker. I mean, at least they got that right in that they did tweak the numbers, and they brought their inflation forecast up a bit, at least in the near term, and their growth forecast down. I just don't think they made big enough adjustments. But the big problem for inflation is not the tariffs themselves. It's all of the inflation chickens that the Fed has been releasing for more than a decade coming home to roost. We have a lot of dollars sloshing around the world thanks to years and years of artificially low interest rates and quantitative easing. And more of those dollars are going to be coming home as foreigners get out of U.S. financial asset. You're seeing a global exodus out of U.S. stocks, out of U.S. bonds. And all that cash is going to come back home, bidding up prices. And I think we're going to see inflation moving up considerably. And I agree with Andy that the economy is going to be weak. So that's the dilemma. It's going to be stagflation with a recession and much higher inflation happening at the same time, really complicating the Fed's ability to try to do something about either problem.
Either problem. And Peter's right, Andy. What we see here is an opportunity for the Fed to simply say that we are raising our inflation outlook. It's going to be hotter than expected. He kept pointing to tariffs, and then he also said growth is coming down. Are you alarmed by that?
Yes, I am. I'm very much alarmed by that because I still think that rates should be much lower. And as far as inflation and tariffs go, I think the tariffs are much more deflationary than they are inflationary. And I think things are going to slow. I think you're going to see it slow down the economy even more. And once we get these unemployment numbers right, and they're absolutely wrong right now, I mean, just look at JOLTS. Last year, there were 10 million jobs out there. This year, there are 7.5 million, but yet the labor market's fine. Of course it's not. Labor market's horrible. And I think it's going to continue to get worse. So I see 3 cuts still this year, and I see 4 next year.
Let's just listen to what Powell said when the markets started to go down into the red, and then we can assess exactly what it was that spooked the markets. Listen.
There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Waiting a couple of months, Peter.
Well, I don't think the decisions are going to get any smarter over time. But, I disagree with what Andy said about the need for lower interest rates. Lower interest rates are not the solution to our problem. They are the cause. The reason we have so many problems is because the Fed left rates so low for so long. So the solution involves much higher interest rates. Now, I understand that's going to be very painful given the economy that we've created built on a foundation of cheap money. It means stock prices come down, real estate prices go down, companies fail, there's going to be bankruptcies, there's going to be defaults, there's going to be a protracted recession, probably a much worse financial crisis than 2008. But all that has to happen because the alternative to that is even worse. But unfortunately, that's the direction that we're headed, which is a runaway inflation, which may turn into hyperinflation.